It's almost 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks rally after the S&P 500 closes above 5,500 points for the first time. Fed Chair Jay Powell says inflation is on a downward path.
I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path.
Xi Jinping and Vladimir Putin in Kazakhstan for the Shanghai Cooperation Organization Summit. That's as European officials tell Bloomberg that China is developing lethal attack drones for Moscow. And the fresh word of wars between Hindenburg Research and India's markets regulator sheds new light on those involved in the short sellers' scathing report against Adani Group. All right, before all that, though, let's check in on how markets are faring. Avril Hong's in Singapore. Avril.
Yeah, Paul, it's interesting today how the focus is really on those comments from the world's most influential central banker, Jay Powell, right? Talking about how the last inflation reading showed this disinflation path. I think that's what prompted the rally on Wall Street, among other things, overnight. And the S&P 500, as you just mentioned, clocking a 30-second record for the year, well above 5,500. But what we're seeing in the Asia Pacific is not that much of a follow-through. Not that impressive, all things considered. And part of the reason potentially is because of how Trump is fueling these bets of higher U.S. yields and upward momentum on the U.S. dollar. That's going to cause more pain for this part of the world, whether you're talking about currency. Certainly we're seeing that in the won, the yen, the renminbi today. I'll talk a bit more about what we're seeing in dollar China, but I also wanted to highlight what we're seeing in the Chinese bond rally. That's continuing today, despite petering out earlier in the week after authorities said they would borrow bonds, and that raised speculation they would sell this to help curb the rally. Analysts have been pointing out that even though this might help put a floor on yields, it is unlikely to quash the rally. Simple reason is that the fundamentals driving the bond rally are unlikely to reverse. You think about the weak Chinese economy. Today we're getting the Tyson Services PMI at an 8-month low, and then those expectations of monetary easing. So that's what we're seeing in terms of the Chinese bonds. But let's flip the board and take a look at dollar China. Today, the PBOC came through with a yuan fix above 713, and that seems to be confirmation enough for yuan carry traders. And, you know, this expectation, I think, that despite the continued climb in dollar offshore yuan, if you take a look at the 1-month implied vols, it shows they don't quite expect a sudden pullback or sharpening, strengthening of the Chinese currency. That expectation that the PBOC's approach is until the Fed starts easing, if they're going to keep these higher for longer narratives going along, there's very little the PBOC can do, Paul.
All right, thanks very much, Avril. And Federal Reserve Chair Jerome Powell and ECB President Christine Lagarde spoke in Portugal about their policy outlooks.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. Frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right, and that's what we're planning to do.
We still believe that it's likely to be a bumpy road until the end of 2024, but we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front.
Well, for more on how markets are reacting, let's bring in our MLive strategist, Mark Cranfield. Mark, kind of an interesting day, really. We've got Powell talking about disinflation, risk on in the US. Not really the case here in Asia, though. But markets hearing just part of what Jay Powell is saying. The other part was, well, look, he needs more evidence before the Fed's prepared to move. Is there still a bit of a disconnect in terms of what the market thinks and what Jay Powell thinks about when easing's going to happen?
He's certainly going to have a lot more trouble in convincing traders that he really can get interest rates down and that inflation is doing what it wants. It's been a bit of a stop-start year. Right at the beginning of the year, traders heard Jerome Powell being very optimistic on the outlook for inflation coming down into the target zone. And it sounded as though he was ready to push the Federal Reserve towards pretty early interest rate cuts. In fact, at one stage, we were even talking about having rate cuts in the first quarter of this year. But then, of course, that was thoroughly upended when we had some inflation numbers that were far too hot from the Fed's point of view. So there's been a lot of backtracking since then. The dot plots have changed. We only have one priced in for this year. So although Jerome Powell is probably encouraged, traders are going to need a lot more convincing that he can really push the committee over the line to get an early rate cut. So we're not going to see too much repricing in the markets. Probably people will still be happy to stick with the idea that in December we could get one interest rate cut, but we need to see a lot more evidence from inflation data before people are really excited that yes, the Fed is on the way to doing more than one cut, and whether it's going to be any earlier than December. We've got the jobs report coming up, and employment has been consistently very, very strong in the United States, way too strong for interest rate lowering. So again, traders will be a bit skeptical about that. And then you've got lots of discussions about the US presidential election, which again could keep people a little bit more cautious as well. So we probably won't get traders getting too far ahead of themselves in terms of optimism about lower inflation just yet.
Well, we did see the S&P break through 5,500 points, and normally you'd expect to see a bit of follow through to Asia, but not the case today. Why not?
Well, you've got companies like Tesla, for example. They had a huge run up yesterday, 10% gain for that company. And some of those tech stories in the United States have not been translating particularly well across to Asia. They're becoming quite centric to the United States. So some of these companies that you've seen, Nvidia, Apple, Microsoft, whoever it is in the tech space, there's some spillover to specific companies in Asia, but on a broad sense, we've seen for a long time that the United States is outperforming in many areas, particularly the NASDAQ has outperformed most things this year. And there's no particular reason for that to change in the near term. It's the sheer weight of numbers. So much money is being drawn in by investment flows to the United States into the big caps, and that money isn't going into the rest of the world. So it's the US is taking it away from emerging markets, from some of the European markets as well. And as long as the US dollar remains very, very strong, there's no major reason for global portfolios to shift anywhere. Just stick with what they know. The winning story is the United States, and from what we're seeing, that has got quite a way to go yet.
Yeah, and in terms of dollar strength, look, pick a currency in Asia, basically. But let's look at the yuan, for example, continuing to weaken today. We've got traders adding to long US short yuan positions. Is there a sense that maybe the PBOC is just throwing in the towel here?
Not so much throwing in the towel. I think it's more of a recognition that they can't do very much about the US dollar side of the equation. They can't stop the United States in terms of monetary policy. Whether the Fed cuts early or not, that's completely outside the control of the PBOC. The American economy is extremely strong. All the PBOC can do is concentrate on what's at home, and they need low interest rates to support their economy, which is generally struggling and not meeting the expectations. So as long as that persists, it's the currency is the safety valve. You need to have a slightly softer currency in order to make up for this huge yield differential, much the same as the dollar yen, where the Japanese currency is underperforming again because the yield differential is huge. So it's more recognition that let's slowly allow the yuan to get a bit weaker rather than let the market just completely take it into its own hands, which could be much more damaging. You could be a lot more volatile. The yuan could come under very strict pressure from traders if the central bank just gives it a free rein. So better to allow a modest depreciation of the currency over a long period of time rather than have these big shocks where you might get dollar yuan jumping by huge amounts from time to time. So that's probably a strategy which they're going to run with possibly all the way through to the US elections.
All right, MLive strategist Mark Cranfield there. Let's bring in our first guest who deals with the risk across different credit markets. Connor Fitzgerald is portfolio manager for fixed income at Wellington Management, which manages more than $1 trillion worth of client assets. He's usually based in Boston, joining us today from Singapore, though. Connor, thanks so much for your time. I just want to start, if I can, with those remarks from Jay Powell that we heard today. So we've got some progress on inflation, rate cuts for this year boosted. Have you changed your view at all?
Thanks for having me on today. No change to our view. We still think the progress on inflation is slow but steady. We do think the Federal Reserve is biased to cut, certainly more than their willingness to hike. We think the labor market data that we expect to get over coming weeks will continue to toe the line on that same story. So I think the message from the Fed will continue to be exercising patience, but really looking for an excuse to cut. I think they'll be particularly focused on any sudden weakness in the labor market. We think we've seen sort of gentle loosening there, if you will, but we are already at the unemployment rate that the Fed forecasts for the end of the year. And I think if that were to accelerate and become much looser than expectations, that would be a case for them to act more boldly in terms of cutting rates.
Yeah, definitely an easing bias there. The question, though, is timing. Do you think the market's getting ahead of the Fed when it comes to when easing might actually happen?
I think the swaps market is pricing in maybe one or two cuts at the moment. I think that seems about right when you consider the bias to ease. Certainly a lot different than what we saw at the beginning of the year when we saw 8 to 10 cuts priced in. So I don't think they're nearly as ahead of the market as they were earlier in the year. So right now I don't see a huge opportunity to bet one way or the other based on where the swaps market is priced.
I want to talk a little bit about the last US presidential debate as well, the possibility of a second Trump presidency now coming into sharper focus. How would that eventuality affect the credit market and the way you approach the credit market?
Sure. So we do think a Trump 2.0 presidency would be a big deal for bond markets, particularly for treasuries, and particularly if it came alongside a Republican sweep. And we're really focused on three key Trump initiatives or policies. The first one would be restricted immigration, which we think would reduce labor supply, potentially push inflation up. Second one would be tariffs, also inflationary, and that we think it would push goods prices up, and goods prices deflation has been a big part of the moderation we've seen in inflation the past few years. And the last one is deregulation, which we think is sort of growth positive, all else equal. So when we put those three things together, we do think if Trump were to win, particularly with a sweep, that would push long-end Treasury yields in particular, potentially significantly higher. What that means for investment-grade credit, generally speaking, when we see higher yields or higher borrowing costs, there's less demand to issue from corporates, and that usually leads to tighter spreads. But we would note that credit spreads today are exceedingly tight. So for now, we don't think it's a major event one way or another for credit spreads if Trump were to win.
One conversation that's increasingly being had publicly is the possibility or the potential, at least, for a withdrawal of President Biden from the race. Is that a scenario that you're gaming out or considering at all? How unlikely or likely do you think that would be, and what could the potential impact be?
We just recently started gaming this out, I would say, in the last 24 hours. One of the things we were looking for after the debate was signs or comments from Democratic leadership that they would be willing to consider a new candidate, and we've gotten that sort of in the last 24 hours. If you were to look at head-to-head matchups of, say, Kamala Harris versus Trump, she looks pretty similar in terms of polling levels, but those are also hypothetical polls, so it's hard to say. But the timeline is pretty compressed, pretty short in terms of what that could mean if they really changed candidates. There's a lot of technicalities to work through, so I would say that's something we've started to focus on more recently. But really, what we think is most important is just the swing, a pretty significant swing in favor of Trump when you look at a state like New Hampshire that the Democrats won by a good margin in the last election. They're now polling behind, and we've seen a significant swing there, as well as across some of the other most important swing states where he was already in the lead, but he's now increased his lead. So we're looking at that as the most likely outcome right now.
Yeah, and if a withdrawal scenario were to take place, which corner of the credit market do you feel could be the most impacted?
I think a withdrawal scenario would only matter for the credit markets in the sense that it would be a change to the status quo. But I think generally speaking, we think if the Democrats were to win, there was a divided Congress. We think that's sort of more of the same in terms of the policies that we have right now. So we don't necessarily think that would be a big change to markets. Really, again, the change to markets that we think is really worth paying attention to is a Trump sweep, not one where we land with a Democratic president and a split House and Congress.
Look, regardless of who wins, both candidates seem to have pretty big spending plans. The budget outlook in the US could mean more supply of US Treasuries. So with that in mind, do you prefer investment grade, particularly a US investment grade, over US Treasuries?
We do still prefer investment grade credit. That's certainly our most preferred allocation across the broad credit sectors. Right now, we're particularly favoring shorter maturity investment grade credit securities to clip some income. We also see better relative value in that part of the market relative to history, especially relative to the longer dated parts of the credit market. But I think most importantly, just given how tight spreads are, we want to keep our spread duration down and reduce sensitivity to reduce sensitivity to widen credit spreads, because we are nearing historic tights depending on how you look at the market.
All right, Connor Fitzgerald, we are out of time, unfortunately, but thanks so much for joining us. Connor Fitzgerald there of Wellington Management. Still to come on Bloomberg Markets Asia, Vivriti Group is going to join us to talk about private credit opportunities in India. Hear why they believe the market has more room to grow. That conversation coming up. This is Bloomberg. Bloomberg has learned that China is making and testing lethal attack drones for Russia. That's according to European officials familiar with the matter. China correspondent Min Min Lo joins us now in Hong Kong. So, Min Min, is this a sign that China's moving closer to providing the sort of lethal aid that Western officials have been warning about?
Yes, Chinese companies are said to be developing a version of a drone that is modeled after Iran's Shahed drone. Now, these are known as kamikaze drones because they're not meant to survive the attack. They can loiter for hours before locking on a target and striking. And it's cheap to make but hard to defend against. Russians have been using thousands of these drones since the start of the war. And the worry is that China will be able to produce them at a much faster rate than Iran. And these European officials who spoke on condition of anonymity are also concerned that this would cross the red line of providing lethal weapons for Russia. Now, the Chinese embassy in Washington has denied that China provides any weapons to any party of the war and made a veiled swipe at other countries that are providing weapons to Ukraine. And China also says it is strictly controlling the export of dual-use equipment to Russia. Of course, it's been accused of selling these ball bearings, components, and dual-use equipments to Russia for some time now. And if this new development is true, then it could likely trigger a very strong response from the West, perhaps even sanctions on China.
Well, President Xi now, of course, in Kazakhstan. He's there for the Shanghai Cooperation Organization Summit. What can we expect there?
Yes, President Xi is there along with President Putin as well. That's the second time that these two presidents are meeting in 2 months after Putin visited China back in May, when the two sides really hailed their relations and promised to deepen cooperation when it comes to economic and military ties. Now, one big announcement we're expecting from the SCO summit is that Belarus is expected to join as a full member. The president of Belarus joining this summit for the first time. And that would bring the total members of SCO to 10 after Iran joined last year and also India and Pakistan joining in 2017. President Xi likely to hail this as the growing relevance of SCO to the world, really part of his campaign to push towards a multipolar world order. Now, economy is going to be on the agenda because many of these Central Asian states are important partners in China's Belt and Road Initiative. They're also likely to discuss anti-terrorism measures given recent developments in Pakistan and Russia as well. And geopolitics and that war in Ukraine likely to be in focus as well, especially with this new accusations that China could be developing drones for Russia. Paul?
All right, China correspondent Min Min Lo there. Staying with China, Finnish President Alexander Stubb says Russia is so dependent on China that President Xi Jinping could possibly end the war in Ukraine with just one phone call. He spoke exclusively to Bloomberg in Helsinki.
In the beginning of the war, I think China was sitting on the fence. It was sort of looking around, trying to understand what was happening and why Putin was doing it and what the ramifications are for itself. But as time has progressed, and we're now almost 2.5 years into the war, China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
How likely do you think that that phone call would be made?
I don't know, but I call upon China to do that. If China is genuinely interested in peace, if China is genuinely interested in harmonious relations between nation states, it cannot allow a country like Russia to drive an imperial, at the end of the day, aggressive and colonial war against a independent nation state. It needs to protect the international rules which are linked to territorial integrity and sovereignty. That is the right thing to do, and that would also show leadership from China. And I think it would get a lot of goodwill, not only from the global south, but also from most countries in the global west, were it to be taking a stronger role in ending this war.
That's Finnish President Alexander Stubb speaking exclusively to Bloomberg News in Helsinki. Just got an alert on the Bloomberg terminal for you about Chinese government bonds. We are, of course, watching this space very closely. We understand that China's Ministry of Finance have notified underwriters to resubmit demand for Friday's 30-year government bond auction. This is according to people familiar with the matter who can't be identified because they're not authorised to speak publicly. But this is what we know. Requests to underwriters to resubmit the bond auction, demand have been issued in the past when there's a change of market environment, but they do tend to be a rare occurrence. And of course, we do have yields at record lows there. The PBOC hasn't sold any bonds yet, but there is a lack of quality long-term assets in China at the moment. So there is the yield on the 30-year for you. Not a great deal of change at the moment, but as I mentioned, we do have yields at historic lows in China at the moment. And now this news that China's Ministry of Finance notifying underwriters to resubmit demand for Friday's 30-year government bond auction. Plenty more to come. This is Bloomberg. Welcome back. We've just got China markets heading out to lunch. Avril's with us in Singapore. What are you watching, Avril?
Yeah, Paul, we're seeing Asia stocks mostly running higher today, tracking Wall Street after Jerome Powell's comments helped to spur the optimism that we're seeing progress on inflation that will help the Fed to ease rates. Hang Seng is leading the pack today. We're seeing gains on the Nikkei as well. Tech is doing well, and we're seeing a bit of a reversal in the gains from the financial-related stocks just a day ago in Japan, such as the insurance names. The CSI 300 is the outlier. I mean, today we just got yet more worries coming through on the bleak prospects for the Chinese economy. Tyson Services PMI, not just worse than expected, but also at an 8-month low despite showing expansion and just showing how the deflationary pressures in China persist. Let's take a closer look at what we're seeing among some of these stocks that we're really focusing on today, because overnight, of course, we did get Tesla showing that drop in sales, but it wasn't as bad as anticipated. So we saw the stock rev up 10%. That seems to be raising some optimism of recovery in sales among some of the other EV makers that have as well been pressured by price wars slowing EV demand. So Li Auto, NIO in the green, but we are also keeping a close watch on BYD after it showed really good sales, and that's spurring the optimism towards the price of the stock. If you flip the board and take a look at this next chart, it will actually show you how it's leading the pack versus other EV peers, and it looks like a divergence that will only widen. Couple of things that BYD has going for it. Among them, its tech rollouts, the plug-in hybrid models that have really helped its sales, and also think about how the latest round of EU tariffs compared to the average, the tariffs for BYD were seen as lower than some of the other peers. So this is among the trends, the themes that we're watching for now. Paul.
All right, thanks very much, Avril. Let's turn to some political stories that we're tracking today. President Biden is blaming jet lag after trips to Europe for his poor debate performance, admitting that he did not have the best night and should have listened to his staff. He visited France in June, then returned to Italy days later for the Group of 7 Leaders Summit. Biden now plans to meet with Democrat leaders in a bid to reassure supporters over his fitness and mental ability. The Washington Post reports that former President Barack Obama has privately voiced concerns about Biden's re-election path and offered Biden his advice. Chinese Coast Guard has reportedly detained a Taiwanese fishing boat and its 6 crew members. Taiwanese officials say the vessel was stopped near the island of Kinmen, a few kilometres away from the mainland, and taken to the Chinese port of Weitao. The detention comes as China looks to ramp up pressure on Taiwanese President Lai Ching-te. Beijing sees him as pushing for independence for the island. The Philippines says it's making substantial progress with China in managing their dispute in the South China Sea. Officials from the Philippine Foreign Affairs Department and China's Foreign Ministry met on Tuesday. Manila says while significant differences remain, both sides recognize the need to restore trust. Last month, a clash in the waterway led to a Filipino sailor losing a finger. Turning to India now, more than 100 people were killed following a stampede at an overcrowded religious event in the northern Indian state of Uttar Pradesh. It's one of the deadliest such incidents in decades. For more, let's bring in our South Asia economy editor, Ruchi Bhatia. So, Ruchi, what's the latest here? What's going on?
Well, a horrific stampede took place in the Hathras district of India's most populous state, Uttar Pradesh, where as many as 116 people have been crushed to death. What we do know so far that a high-level investigation has been announced into into why this event really took place. We also do understand that the Chief Minister of Uttar Pradesh, Yogi Adityanath, will be visiting the site. The Uttar Pradesh government has said that there were many more devotees that were present at this religious congregation than the permitted levels. In fact, mass stampede at religious events are, they keep happening in India. It's it's not a rare phenomenon of sorts. So much so that a 2013 study said that religious congregations and pilgrimages make for almost 79% of stampede-related incidents. Having said that, it all happened when a lot of people moved towards the preacher to seek his blessings. So what we do know so far is that the opposition, of course, is training their guns at the administration, asking them as to why proper arrangements were not made. But clearly, it's one of the deadliest incidents that we have seen in the recent years.
Yes, as you say, not particularly unusual, and it's perhaps telling that there is, in fact, a set of statistics for these sorts of things when they happen. Is anything going to be done to prevent a recurrence in the future?
Well, as I told you, what we do know so far is that a high-level investigating team is investigating into the issue to understand as to why the event really took place, whether proper permissions were in place or not. They will also assert, and in fact, the opposition has been asking for a CBI inquiry into this issue to investigate as to whether proper permissions had been granted by the authorities to the preacher. What we do know so far is that the government has announced that some money will be granted to the families of the deceased. Having said that, as we told you, this is not an uncommon phenomena in India. It keeps happening every now and then, but needs to be seen what the administration will do from here on to make sure that such incidents do not take place again.
All right, South Asia economy editor Ruchi Bhatia there. Plenty more to come. This is Bloomberg. India is emerging as a hot market for private credit as global firms deploy billions of dollars into the fastest growing major economy. Vivriti Group is capitalising on that rising popularity. It offers debt finance to mid-market enterprises and aims to raise as much of $250 million for its third fund. Joining us now from Chennai is founder and MD Vineet Sukumar. Vineet, thank you so much for joining us. I just want to start by asking you to describe the appetite for private credit in India at the moment and where the demand's coming from.
The demand is largely coming in from financialization of savings in the Indian market itself. Unlike other markets in Southeast Asia where the appetite is coming in from global firms, in India it is largely homegrown. In fact, last year, as much as $2.5 billion got raised for private credit firms and various funds across strategies just in the last calendar year itself. And that gives you a sense of how this market is developing. Private credit is still the smallest part of the alternates segment in India, but the highest by way of promise. And I think this year and the next year should be very, very good for this market.
Yeah, well, as I mentioned in the introduction there, you are raising money for your third fund, but it's also happening in an environment of tighter rules from the Reserve Bank of India. So under those conditions, who are your major investors and where are you going to be looking to deploy that cash?
So on one side, I think the demand is coming in substantially from the private wealth community. India is a market where per capita is building up, dollar millionaires are increasing, and as a result, we are seeing a lot of disposable savings finding their way into alternates. India is a market which has been predominantly focused on real estate and gold as a method of saving for Indian households for the longest time. But this is steadily changing as the asset management industry is making significant inroads in building awareness and building acceptability of their products in this market. The Reserve Bank of India rules that you alluded to is actually limiting the institutional market from participating in alternates. But that market was frankly only 10% at best of the overall market size by demand. And therefore, I think those rules are going to have a limited impact on the growth of this market. I think it will grow on the back of private wealth rather than the institutional market. Where we seek to deploy today... Sorry.
No, please continue.
Yeah. Where we seek to deploy is largely the mid-market segment. India has a hugely untapped base of 15,000+ mid-corporates that are rated BB, BBB, single A, outside the realm of debt capital markets as it stands today. This market is very ripe for discovery, very ripe for building structured finance, for building the bond markets, both primary and secondary. And we think that it is very, very rich picking for private credit for at least a decade more.
So you mentioned a minute ago that you don't see a huge impact from banks and institutional investors not taking part due to those tighter RBI rules. But do you see perhaps an increase in shadow lenders tapping the private credit market?
I think this market is going to evolve around two axes. One axis is going to be about mainstreaming of the Indian corporate sector. The Indian corporate sector for almost the last decade has been languishing because capital expenditure has been poor, and there were significant impediments to growth, significant impediments to government on account of government policy. In the last decade, the government has steadily chipped away at these boundaries and improved ease of doing business, and that's paving the way for mid corporates and entrepreneurs to be much more bullish for growth and invest for the next decade. That's one axis. The second axis is really the financialization of Indian savings and the ability for the Indian private wealth community to park their savings with the alternates market. So I think the aggregate Indian private credit market is probably only 1 to 2% of bank credit. And that gives you a sense of how far we have to go and potentially how far are we behind far more developed markets like the US. My own calculation is that we are 3 decades behind the US in terms of where this market is today.
How about in terms of returns? What do you expect to be able to offer your investors?
So in rupee terms, we offer mid-teen returns to investors. For the last 5 years, we've been running products that offer between 12% to 14% in INR terms. Now, this is probably around 500 to 600 basis points above inflation. So 600 basis points real returns today for relatively stable, low duration products that range between 2 years to 4 years in tenure, right? This kind of a product today is frankly not available in the Indian market. The Indian market has predominantly focused on either fixed deposits or debt mutual funds that offer just at or above inflation returns, right? So receiving 600 basis points with periodic cash flows over a moderate duration is a pretty recent offering in the Indian market, and we hope will be quite well received.
Well, the returns you describe are certainly quite attractive, but as the private credit market expands, are they sustainable?
That's a great question, Paul, and I think to that we should look at possibly the demand and supply side of the equation. So, as I mentioned, we are indexing on Indian mid-corporate. Now, this is a market that is borrowing possibly $80 billion annually, and most of that is happening through working capital from banks, right? Now, alternate lenders have only started to scratch the surface. As I mentioned, alternate lenders account for maybe 1% or 2% of banking credit. And therefore, I think as we go deeper and deeper and deeper into a very, very large country, you will see that steadily over the next decade, the market share of alternates starts building up, right? And maybe it's a decade from now is when we will see significant amount of competition and pricing pressure at the last mile. I think we're quite far away from that. In fact, the good part is that because the market is so nascent, asset quality has been fantastic. To give you a perspective, the average default rates that we see in the alternates market in India is less than 0.5%. The average default rate we see in the US, which is a much more developed market, is anywhere between 3 to 4%. And that gives you a sense of how nascent the market is, both in terms of opportunity and opportunity picking, as well as scalability.
All right, Vineet Sukumar, founder and MD of Vivriti Group. Thank you so much for joining us with your insights today. And just as you were wrapping up your thoughts there, the market in India did open and seeing a reasonable amount of movement to the upside at the moment. The Sensex there moving higher to the tune of almost 0.5% right now. The bank index performing quite well, better by about 0.75%. All right, staying with India, a fresh war of words between short seller Hindenburg Research and India's markets regulator is shedding new lights on those involved in Hindenburg's scathing report against the Adani Group, including a New York hedge fund. So for the details, let's bring in Bloomberg conglomerates, media and telecom reporter PR Sanjay. So Sanjay, what exactly was in the security board's show that caused notice, or what was in its show caused notice?
Thank you, Paul. There's a lot of twists and turns in the story, and what we learn, Indian capital market regulator SEBI has named the US one of the oldest hedge funds, Kingdom Capital Management Fund, is named as an involved party in this one. And what SEBI is telling in the show cause notice is that the Kingdom clearly knew about the short seller report much ahead of its publication. Apparently, according to the Shawcos notice, Hindenburg has shared this notice to Kingdom in November 2022, around 2 months ahead of the scheduled publication, and they have reached a pact, an agreement for profit sharing around 30%, and later it has reduced to 25%. And Kingdom later had transferred $43 million worth of money to K India Opportunity Fund to shore up the positions in the name of in the shares of Adani Enterprises, which is a flagship of Adani Group. And later they got squared off and they reaped around 22 million worth of money. And Kingdom had shared 4.1 million to Hindenburg, and they will be later giving $1.4 million additional. So that's what clearly Shawkos's notice is telling us, and that is a clear Shawkos notice towards Hindenburg. That is what we know as of now, and still we try to reach out to Kingdom. We have not able to get a comment from them, and we also reached out to Kotak, which is named, which Hindenburg allegedly saying that very conveniently SEBI has masked the name with K. So we have reached out to Kotak, but Kotak said that we have no connection with this K India Opportunity Fund. So as I said, the twists and turns are there. We are watching and waiting.
Yeah, well, Hindenburg's had plenty to say about this. What's the response been so far?
Yeah, and Paul, this is one interesting thing. This is all turning when Indian Parliament session is there and opposition is taking the case up, and we are expecting that they will also take up this case as well. And now the ISA turns towards Indian capital regulator, and we are the investors also waiting and watching what really happened with the Kotak Bank. Are they really involved or not? That is one question, and we are also expecting more clarification from Hindenburg as well. And we are awaiting a final report from SEBI and its, what is its conclusions on what are those findings, etc.
So you mentioned that Kotak and Kingdom haven't made any comment, but where is this heading? Could we potentially end up in court here?
Yeah, I think it will lead towards that. As you know, the Kingdom Capital Management is one of the oldest U.S. hedge funds, which is established in 1983. At one point of time, in 2007, it had around $7 billion asset under management. And after the investment losses, the Mark Kingdom, who actually transferred $43 million to K India funds, he took the control. Now we'll have to wait and watch. Now there are three parties. One is the Indian capital regulator SEBI, and Adani Group. Of course, it was always in the signer show, and the Kotak Bank is also there. And plus, there's a one of the oldest U.S. hedge funds also there in the race now.
All right, Bloomberg Conglomerates media and telecom reporter PR Sanjay there. Plenty more to come. This is Bloomberg. Sources say a growing number of top bankers at China's premier investment bank, CICC, are pledging their loyalty to the Chinese Communist Party. That's the focus of today's Big Take. Let's bring in Asia Investment Bank senior reporter Kathy Chan joining us from London. So, Kathy, what triggered this big cultural change at CICC?
Yeah, hi, Paul. This is really the ideological shift happened in China. Undertaken by President Xi Jinping and also the Common Prosperity Campaign. Basically, the idea is to emphasize the importance of party values, equal distribution of wealth among people, which constitute basically a big cut in pay and salary of these bankers. So this drive to reduce income inequality is really driving the changes internally. And of course, the appointment of the new chairman from the state-owned brokerages, Galaxy Securities, last November is really the major trigger for the change internally.
So what's it going to mean for day-to-day operations? Any impact there?
Yeah, with the appointment of the new chairman, the first thing I was told by sources is that pretty much every meeting started with more ceremonial practices, basically reciting Xi Jinping's slogans, ethos, and to talk about party values and give updates about of the state council meetings. All these political sort of like thinkings are infused into the minds of the bankers before meeting starts. And another changes and impact will be more the work culture, because there are low expectation of low expectation of salary and bonuses. The general work culture is pretty slack right now, and in generally speaking, the morale has plummeted. People just don't realize they work for the party, they are not for themselves. So the culture has changed from being aggressive to more complacent.
Yeah, and I understand people are leaving the office on time as well. What does it matter, though, being a Communist Party member in a state-owned firm?
Yeah, definitely. Being a member is no longer a formality issue. It's basically seen as a potential pathway to career advancement. It kind of provides some sort of like career, they call career trajectories, because being a party member, if you perform well, you basically get a good chance to be promoted. So a lot of people internally are seriously thinking whether they should join the party or not.
Just quickly, what are the broader impacts on the firm? The share price has suffered a little.
Definitely. I think the global, the capability of doing deals overseas could be impacted, especially when you have these old guards, CICC people are thinking about leaving the firm because, again, for the same reason, they're given zero bonus last year and 2 years already. There is the difficulty to retain talent. At the same time, you know, with the whole firm more geared to the Xi Jinping's thoughts, basically that will create a lot of skepticism among the global investor and clients.
Okay. Kathy, we're out of time, but thanks for joining us. That's Bloomberg Asia Investment Bank senior reporter Kathy Chan joining us from London. And you can get more on this story on the Bloomberg terminal, on Bloomberg.com, and also the Big Take Asia podcast. And you can listen to it on iHeartRadio, Apple Podcasts, and Spotify. New episodes of that podcast dropping every Wednesday. Well, that is it for Bloomberg Markets Asia. Horizons Middle East and Africa up next. This is Bloomberg.